Wondering what depreciation is and how it works? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And one thing that confuses people a lot is depreciation. So I wanted to do a little bit of a video on this particular topic. Now don't worry, there are going to be some accounting terms in it, but as always with these videos, I'm just going to give you the common scenarios, the main things you will see as a small business owner in this world. So when you look at your accounts, you can see what that figure means and kind of why it's important, and also how it works for tax, because depreciation works in quite an odd way for tax. So let's get into it. But before we do, if you like these type of videos, make sure to click the subscribe button below so you get notified whenever we release more just like it. So what is it? Well, depreciation is really, when we're talking about it in the small business world, it's a decrease in value of something that your business owns. So you might hear the term asset. That's normally something that you own. And in this instance, we're going to be talking about a piece of equipment. I'm going to use a MacBook because I think that's quite a common piece that we see in the small business world, and it applies to a lot of situations. So when you're thinking of this and we're talking about it, let's think about a MacBook, but it could be any bit of equipment quite often that you're going to be looking at in your business, and where you're going to see this in your accounts. Now, why is it important? It's important because if you were to look at your accounts, you normally have two docs. Sometimes there's a few more sheets in the accounts, but really there's two main ones you're going to look at. One's called the profit and loss, and there's more videos on our YouTube. You can see those if you want a bit more of an explanation of the profit and loss. But basically, it shows you what you're earning over that year. So if you're looking at your year's accounts, it's going to show you kind of what you've earned over the year. Now, what they'll do is, if you imagine, if you ignored the piece of equipment that you just bought and you made 10 grand profit, actually that piece of equipment you've spent money on is going to go down in value as the years go on, and there's nothing in those accounts at that point to say or show or demonstrate that loss in value. So that's not going to be true, because actually that money you've spent is going to, some of it is going to need to come off. The alternate way is if you'd put the whole cost through. So let's say you bought a £2,100 MacBook. When you looked at that, if you put £2,100 in your profit and loss for that year, that's not true either, because it hasn't taken that whole MacBook to make that year's profit. That MacBook's going to last for many years, and normally with depreciation, what we're talking about is a piece of equipment that's going to last for a few years. You wouldn't normally get involved with depreciation if you're doing like a £20 screwdriver or something like that. We're talking about relatively big bits of kit, say probably more than about 200 quid, and they're going to last over a few years time. So yeah, if you included the whole cost in the 1 year, that's not true either, and you'd look like you were earning less money. So you got both sides of it. If you ignored it completely, you'd look like you're earning more money. If you put it in its full, you look like you're earning even less money than you probably should be. So depreciation kind of spreads the cost of it over its life. So that's what it's all about. So quite often, in order to get that right, what happens is you look at it and you say, okay, what is the life of this particular piece of equipment? So what is the life of this asset? Now, normally in accounts, quite often you're going to see 5 years. So they're going to spread it over 5 years. Sounds about right. If you think about maybe your office computer or something, you might replace it. If you're into tech, you might replace it a lot sooner, but generally they're going to be quite a long piece of kit. And actually with MacBooks themselves do tend to last quite a long time. So yeah, you've got this bit of kit, 5 years. So there's two methods from an accounting point of view that people generally use. The most common one's called straight line, and that's probably the easiest one to understand. And all they do is they say, right, the MacBook is worth £2,100 when we bought it. We think in 5 years' time it's going to be worth 100 quid on eBay for parts. So what we're going to do then is take the remaining value, the £2,000, and just splice it into 5 years. So £400 every year. So in your accounts, year one, you'd see a £400 depreciation charge, they call it. And that just shows the drop of value in that set of accounts. Now, the other side of it, I said to you in the accounts, there's two documents. The other one's called a balance sheet. Now, the balance sheet shows you kind of the state of the business overall. Again, there's more videos on this, but it will show you what the business owns. And of course, right at the top of there is quite often the equipment that it owns. And it gives you what's called a book value. So if you imagine when you bought that piece of equipment, that MacBook, it would go on your balance sheet at £2,100, but obviously it's going to drop in value each year by £400, as we've just said in this example. So if you looked at it in, say, year three, it's going to say £900. Now, the big thing to understand with that is that it's not, we're not saying it's worth £900 particularly, because actually in year three you might find actually it's only worth 100 quid then when you get to sell it, or actually you've ended up with some rare MacBook and it's worth double the money or something like that. If that does happen and you have to get rid of it, or you're going to sell it because it's a good idea, then don't worry, it's all dealt with in the accounts at that point, and I'm not going to go too deep into that here, but you would adjust for that in the year, so don't worry. But the takeaway for that is when you're looking at a set of accounts, either your own or maybe you're looking to buy a business, that book value of what all these assets are worth is an indicator, really, is the best way to think of it. So take it with a massive dose of salt. It isn't really the market value. There are some instances where companies might adopt a policy of revaluing stuff, but generally in the small business world, outside of, say, investment property and things like that, you won't generally see it. So that's the takeaway. It isn't actually the value, and it doesn't need to be. It's almost an approximation, I guess. The accounting standards set how this is done. So that straight line depreciation we're talking about, that's how it works. Every year, £400, £400, £400, £400. By year 5, then it'd just be left at £100 on that balance sheet document as what it's worth, scrap, really. And again, and you do that with multiple things. If it was a van, it'd be exactly the same. Now, the other method you could do is something they call reducing balance. Now, reducing balance, what that is kind of as it sounds, really, is you apply a percentage. So you might say, I'm going to reduce my book value by 20% each year. So you just take your 2,100, take your 100 off because you think that's what's going to be left. So you've got £2,000, and then you're going to apply a percentage each year of 20%. So what that means is that the depreciation charge is going to be heavier and larger in your profit and loss. It's going to reduce your profits more in the early years. Now, some people feel that's a better fit because actually you might think, for this bit of equipment, I'm going to get the most use out of it in the early years. And if you think that, then this is a good policy for you. We tend still to see straight line more commonly than this one, but on occasion this does fit a bit better. So if you think this is you and that reflects your business a bit better in those assets, then definitely this is an option. And that's how that works. So that will just every year you just apply a percentage and it drops down. So they're your two main methods you're going to see. Now, how does it work for tax? Well, for tax purposes, the tax people, HM Revenue and Customs, actually forget depreciation. They say we're not going to allow you anything for the depreciation on this. However, we are going to create a new set of rules called capital allowances. And that's kind of their version of depreciation, is the best way I can simply explain it. And they provide their own set of rules for giving you tax relief on those bigger items. And their starting point is almost like a reducing balance. They'll say that there's different levels of pools. And again, we could do a whole video on capital allowances, and it might appear later on. But what generally happens is the expenditure gets pooled. So all those kind of MacBooks and bits of equipment get pooled quite often. Now, and you might get something like, they'll say you can have 18% a year then, or something like that. And it varies depending on the year and the tax rates, and allow that. Now, that's going to take a while to do in order to get the full tax relief. So what they did many years ago, and it's still here now, is something called annual investment allowance. And that's a really cool relief. That means if you buy these bits of equipment, you can actually take all of the cost of that off in year 1. So if you imagine if we were doing that in the accounts, that's like us saying we're going to depreciate the whole thing in 1 year. Of course, we don't want to do that for the accounts purpose, because we kind of want it's our figures as well. We want to know what the real kind of approximation of the real profit is. But for tax purposes, they recognise you've spent this cash, and actually they want to encourage that investment in new equipment and things like that. So that means you get the whole tax relief in 1 year at 100%. And again, there's top level stuff. There's loads of caveats to this, but generally for most bits of standard equipment in a business setting, that's the kind of thing you're going to do. And actually, we did another video recently, if you're listening to this now, the other side of April 21, where if you're a limited company, there are many assets when you buy them new that qualify for 130% tax relief, which is incredibly good. So check that video out if that's you. So there is tax relief to it, but it's really important to know that the depreciation in your accounts really is for accounting purposes, for you to kind of get a true picture of where the state of your business is. And for tax, they're treated under the capital allowance rules. So key takeaways, number 1, you're going to need depreciation in those accounts. And the reason that is you want your accounts to show really a fair estimation of the profit. Even though we're talking about some round sum figures with depreciation, it's much more realistic to have that depreciation spread out over the life of the piece of equipment than it is just to put it all through or not to put it all through. So that's one. Secondly, as a result, when you look on your balance sheet and look at the value of your assets your company owned, that doesn't actually always reflect the market value. In fact, it probably never will in the majority of cases. So bear that in mind when you're looking at that or your own accounts or any other set. And then thirdly, for tax purposes, depreciation is ignored and it's replaced with these capital allowance rules, which is a completely separate deal. So that's depreciation in a nutshell, really quickly explained, completely top level stuff, but hopefully you've come away with a better idea of how it works. And if you do know anybody that needs to know this information, please do share this video with them, and we'll see you on the next one.